Well, good morning. Thanks to everyone who has attended. I'm just going to go and wait for about 60 seconds before getting underway. Those of you who have joined us, thanks again. And just a quick read of that risk warning on your screen. A reminder, everything presented here is general advice in nature. Anyone who chooses to participate in the Q&A section is doing at their own free will. And any of the information that you hear today is my views and not of City Index or our umbrella parent company, StoneX Financial. And as you're here as well, just a reminder, if you do want to go and ask any questions throughout the course of the presentation, please shoot them through on the platform, and then I'll endeavour to go and answer them at the end of the presentation. I'm happy to go look at individual markets and anything else in between, but do make sure you send through those particular questions throughout the course, and I'll try and address them at the end. And hello to my next door neighbour's dog who's decided to go and start barking at the most opportune time. Well, here I am, and yeah, thanks to everyone who has joined me today. I feel like I'm staggering in towards year end. It's been another pretty hectic year, lots of volatility, particularly the last couple of months with what's been happening when it comes to the Fed interest rate outlook, the resilience of the US economy, and of course, the geopolitical situation around the world, and then now the threat of tariffs and everything else in between that may be installed next year. So I'm looking forward to having a break at the end of next week, but nonetheless, we have some pretty big events coming up that I'll look to go and address today. Of course, forefront of those is the Fed meeting. Now, last big event of the year, excluding the BOJ, which comes out around about 12 hours afterwards. Hopefully, don't know a time that they go and release, but then that's going to be really the key driver, not only beforehand, but then probably in the immediate aftermath heading in towards Christmas. So we'll look at what some of the signals are at the moment, what the Fed might go and do when it comes to its updated dot plot, its economic projections, which are going to be very important, in particular when it comes to FX market movements and maybe some of those assets with no yield offering. And also we'll go and have a look potentially at the end at the BOJ and what to maybe go and expect there, because there's a lot of uncertainty about exactly how they will play, whether they'll hike at this meeting, what size potential hike it will be if they do go. So lots to go and cover off today. Let's get straight into it. I want to go and start having a look at 10-year Treasury note futures. So we talk about 10-year benchmark yields, very important instrument that a lot of asset prices are valued off around the world. Indeed, almost everything's priced off that particular asset. Looking at that, this is the note future. So it's the price of what's expected to go and be where the underlying Treasury is going to sit in the future. Here's what it's looking at right now. And we saw for a long period of time that yields, benchmark yields, were falling quite aggressively. The US dollar was losing some steam and the like. But then have a look at the price action that we've seen over the past few sessions. And really, it started to go and kick off when China announced its latest stimulus measures potentially coming down the pipe. No specifics, of course, but some pretty aggressive language that could go and entail that potentially we'll see some pretty big moves at the monetary and fiscal front in the not too distant future. And that, of course, given the size of the Chinese economy, is a good thing for global growth and might have contributed to the reversal we see here. Now, it wasn't quite a bearish engulfing candle on the day, but what you can see is that we did see a reversal back through the 200-day moving average, the 50-day moving average, and then that uptrend that was established in the middle of November. And you can see here at the moment that it's broken cleanly through that, along with a very minor support level. So looking at that picture right now, the price is rolling over, RSI 14 is rolling over, you have MACD about to go and cross over from above, confirming the bearish momentum signal. So when it comes to the price, the futures price for this really key instrument ahead of the Fed meeting, it's looking pretty dire right now. It's looking very heavy, and that implies lower price, higher yields. And that's really important when it comes to particularly the US dollar, because we've known in periods in the past that what's happened is that when you've seen a big increase in yields coming through in the United States, what it's acted to do is go and act like a sponge for liquidity and capital around other parts of the world, even parts of the world that offer higher nominal returns than what the United States does. And so right now, we're seeing here that the price is coming off, and that's going to push yields higher. Now, transferring that across to what it means for the currency, the US dollar, no surprise, it looks almost the opposite outcome. So you can see here the DXY bottomed around about December 6th, and it's been one-way traffic since, and that's when, surprise, surprise, that we went and saw the note futures top out. And you can see here just really strong rally as well. So you can see that in practice, the high yield situation again is being very influential in helping to go and fuel US dollar upside again. And depends on which pair you're talking about. When it comes to the likes of, say, dollar yen, it's really just a pure play on the US rate outlook, we'll look at towards the end of the webinar. And when it comes to a lot of other names out there, I'm thinking about Euro, I'm thinking about Aussie, I'm thinking about Kiwi to maybe a lesser degree, Cable. When it comes to interest rate differentials, it looks like at the moment that that's also playing a part in helping to go and direct market movements in those particular pairs. But so just to reinforce right now that what we're seeing is that yields are pushing higher. The technical picture when it comes to note futures looks pretty bearish. Momentum is turning lower as well. So again, that points to lower prices and the risk that we might see higher yields. And you can see the US dollar is responding accordingly. So naturally, the next question is, well, what's going to go and change that picture next week? What could potentially go and influence the US interest rate outlook, bond yields, and then filter through to the US dollar? And when you look at the incoming calendar, so I've just gone and adjusted this for markets that are either close to home here for us or the really big boppers around the world. And it's going to be a pretty busy week coming up next week. You can see a lot of information. We've got the China data dump coming out on Monday. Interesting to see what's put there. Is there any going to be rubber hitting the road when it comes to those prior stimulus announcements that have come through? Certainly the CPI report that came out, the inflation report earlier this week, does not bode well when it comes to some of the signs there. Still very, very weak demand. But in particular, we're paying close attention to the retail figure and also the property starts, property construction metrics and the like. Still going to be very deeply negative year on year. But what is the change in that? Because that's the real kind of glut that the Chinese economy is trying to go and work through right now. Can we go and get through the other side of this China deleveraging across the property developer sector? If we can, it's a very good thing, but we'll get some insight as to that. But a lot of these information here, you can see we've got flash PMIs coming out on Monday as well, likely to go and be more influential on the euro more than anything else. German economic indicators here, soft surveys. I don't think it's going to really move the market too much, despite the fact that it's got here as being a very high risk event. Canada's inflation report, of course, the BOC went 50 basis points earlier this week and then signaled that they're likely to go and step down the pace of cuts from here, having got policy rates back towards levels that they deem to be more neutral in nature. And just a reminder, I don't think many people say this, given some of the weakness in the labour market surveys and everything else. But Canada's inflation rate, the two core measures, actually came in well above expectations when the last reading came out. So keep a close eye on that, because if we see another repeat of that, then potentially that could go and pressure the BOC to go and start slowing from here. US retail sales on Wednesday as well. This is going to be all the times in Australian Eastern Daylight Time. So it's the Tuesday night in Singapore and other parts of Asia. So another big event there, measuring the health of the consumer. But realistically, everything pales into comparison to what we're going to go and see here. Hopefully you can still hear me. I've got a message OBS has connected. Hopefully you can still hear me at this point in time. You can see here, everything comes back to the Fed meeting. Thursday morning in Asia. Thankfully, it's going to be a bit more of a friendly time zone compared to what we've seen of late. And it really comes down to what is the Fed going to signal on rates? How many rate cuts are going to come through next year based off the median FOMC member projection, how many in 2026, and perhaps more importantly of all, what will the Fed signal in terms of where the neutral Fed funds rate is. And I'll detail exactly what that is because it's going to be very important when it comes to both short end and longer end US Treasury yields. Let me go and bring up what we saw last time from the Fed. That's a little bit smaller, so we can go and make it a bit bigger for you. So this is what the Fed had come up with 3 months ago when it came to its projections. And I just used this in a note that I wrote up about the Aussie and the Kiwi. But all things being equal, just to go and cut things short, the estimates for GDP are likely to go and look undershoot. Its estimates of GDP look very, very skinny relative to what we're likely to go and see, given the strength in the US economy we've seen over the course of this year. Unemployment rate, they're looking for 4.4% by the end of this year. Right now, it sits at 4.2%, so it looks like they're going to overshoot when it comes to its unemployment expectations. So too bearish on that front. And then the core PCE deflator down the bottom. All things being equal, given what we saw with the CPI, and the PPI reports released this week, that figure there, end 2024, looks like it will stand at 2.8%, not 2.6%, as they had 3 months ago. So you've got unemployment undershooting forecast, you've got core inflation overshooting forecast, economic growth is far stronger than expected. But if you look down the bottom and it says federal funds rate, and it's got the June projection beneath that, that's what the Fed is signaling the median FOMC member forecast to where they see the overnight interest rate sitting at the end of each year. And all things being equal, they're going to go and deliver on the forecast they put out for 2024. It's almost a lock now that a 25 basis point rate cut will come through on December. Some might argue that potentially they shouldn't really be doing it, but that is what has been guided by the Fed. However, when you've got unemployment hanging tough, sticky inflationary pressures, growth still motoring along, and the prospect of Donald Trump delivering a whole bucket load of fiscal stimulus measures on top next year, can the Fed really go and stick to the prior forecast 3 months ago that it potentially will go and cut rates by another 100 basis points in 2025? Now, it could signal that, but to me, that would just go and signal that the Fed has given up on its inflation target. I don't think it can go and do that. The markets still have around about another 3.5 rate cuts priced into the OIS curve between now and the end of next year. So all things being equal, the markets expect that maybe we'll get 2 or 3. I can't help but think though, there's given the evidence that's accumulating not only over the past 3 months, but over the course of this year, that the neutral rate for the Fed funds rate, so that's the level where it neither stimulates nor detracts from inflationary pressures and keeps unemployment steady, is higher than the 2.9% level that the FOMC median forecast looked for back 3 months ago. So to me, I would not be surprised if the Fed just signaled 2 rate cuts next year. They've been talking about slowing down the pace. Why not? See what goes on, and then that likely that will have a 3 in front of it. But, and this is the big kicker, if that figure is well north of 3%, so I'm talking about maybe something like 3.2 or more, which I think is unlikely, but if the Fed is starting to feel more confident and hang on, maybe we're not as restrictive as what we previously thought, to me, that would be a pretty big environment and a significant market realization, because it would likely go and push Treasury yields at the front end and the back end substantially higher than where it sits right now. And that points to, as we started off with, the likelihood of US dollar strength. So that's the playbook right now, that potentially the markets have about 2.5 cuts priced for next year, assuming the Fed goes 25 next week. If the Fed goes 2 or even 1, not out of the realms of possibility, given what we're seeing with some of the data at the moment, then that will be probably the biggest market reaction that you'll get from the Fed. Now, before start looking at some markets. I just want to go and cover off as well the BOJ meeting, because that's going to come out around about 12 hours or so. I'm hoping maybe about 10 hours or 8 hours after the Fed meeting. And realistically, it's the last big market event of 2024. A lot of Western markets will go and pull stumps, knock off for Christmas and the New Year, and then come back at some point in January. So it's going to be a big one. And when it comes to what we're looking at when it comes to dollar yen in particular from this event, there's no doubt that initially what we're going to go and see is that whatever the BOJ decides to do, whether it's to go and hike or hold, right now the market is favouring that it will hold, but you've got to remember that over the next 3 meetings, a full 25 basis point hike is essentially priced into that curve. So the markets already expect that at one point or another, the BOJ is going to go and lift by 25 basis points. One of the complicating factors here though, and I wish I could go and give you more clarity on this particular area, is that the BOJ is not a conventional central bank. They don't give us a time as to when they're going to make this move in increments that we associate with other major central banks. 25 basis points is usually the way that most go about it. The BOJ can go 15. That's another factor out there at this point in time. So that's something to go and keep in mind, because there's so many different anomalies. But the key thing to look through this all is that the BOJ is expected to hike by 25 basis points at one of the next 3 meetings. And that comes up to the lead up to wage negotiations coming through and wage increases being announced for the next fiscal year in Japan, which begins at the end of March. The broader factor to remember with dollar yen is that it remains almost a pure play on US bond yields, particularly bond yields further out the curve. So we've got the daily chart here. No technicals in this one, we can go and look at that in a minute. But you can just see, this is actually the wrong. Let me go and get this up. I'll go with US 10Y, just to go and demonstrate the relationship here. So you can see bottoms, and the like. And you can see, so very, very influential movements. This is a 10-year Treasury yield in the United States. You can see that basically when it topped out, so too did the dollar yen. When it bottomed, roughly so too the dollar yen. And you look over here, the rolling 20-day correlation analysis between the two variables here. 10-year yields, 0.92. Even stronger at the belly of the curve, 5-year yields, 0.93. Interest rate differentials suggest it's pretty strong, but then when you look down the bottom here, when you go and look directly at the relationship with Japanese benchmark 10-year yields, 0.38, that implies that there's a very, very weak relationship that when US yields, or when the Japanese yields rise, so too does the dollar yen. That doesn't really fit from a fundamental perspective. It is really a US yield play story. So whilst there'll be initial volatility around what the BOJ does and the BOJ's press conference, updated projections and the like, remember that it will likely, almost certainly, to revert to a play on what the US Treasury yield outlook is. So what the Fed signals, what the rate futures market movements go and signal in terms of directional risk, that's going to be far more important beyond the ultra near term than the BOJ rate decision. With that, let's go and have a look at some of the markets up here right now, just to go and finish off. And I'm going to kick off with dollar yen, because it's a pair that a lot of people like to go and trade right now. You can see here that uptrend. Thankfully, I was paying pretty close attention to what was going on with no futures, and that told me about the risk there. Caught this move, and you can see here now it's grinding higher as US 5 and 10-year yields push higher as well. Price action has been pretty definitive. It was, you can see here, sitting in an asymmetric triangle, broke out of that, and then importantly, it's managed to go and climb above that 200-day moving average, which you look back over time, has been very well respected. So the fact that it's sitting there now is a good sign if you're a bull. Just to reinforce that point, RSI 14, the downtrend that was in place has now been shattered. It's now trending higher. And you can see here, we've got MACD is crossing over the signal line from below, confirming that bullish momentum signal. So right now, the path of least resistance when it comes to dollar yen looks to be higher. So it's really paying close attention to what goes on with US Treasury yields. Let's have a look at the Aussie, because this time yesterday, about 10 minutes away actually, we saw that absolutely stonking Australian jobs report for November. Could barely believe it. I don't think the market's really entirely believed it as well. But unemployment down to 3.9%, another big increase coming through in full-time employment. And then you had on top of that, beyond that fundamental bullish news, you then had the announcement that the Chinese Central Economic Work Committee is going to go and just reaffirm what the Politburo said earlier in the week, that more rate cuts, more fiscal stimulus measures coming through the pipeline next year to go and bolster growth. Another fundamentally strong thing. And just look at that bearish pin that we saw there. Just big bearish reversal, had every excuse to go and push higher, and then couldn't. You see falling wedge, just getting knocked back continuously again at that level yesterday. And this trend line, the October 22 trend line, is an important one. It's been respected in the past, and the last few times that it's touched it, we've seen a big bounce. But you can see on this occasion, we had a break here. It looked like it potentially could be a false break, but then now we've got the pricing right back beneath that as well. And when you talk about when it comes to the drivers for Aussie US right now, yield differentials, especially around the belly 5 years and 10-year differentials with the United States, have been quite influential when it comes to its movement. So given what we're looking at when it came to note futures, the downside risks to the price, upside risks to the yields, that along with the price action suggests the path of least resistance right now for the Aussie is likely to be lower. Euro, it's always worth having a look. You can see here, really tried its best to go and get through 106, but just not able to go and do that. And again, reinforcing the importance of what's happening in the US Treasury yield market. As yields turn high in the United States, euro has turned lower. It's yield differentials really that have been very influential when it comes to euro-dollar movements right now. On the downside, you can see 104.61 is a very minor support level. If that was to go and give way, there's almost nothing to go and speak of until we get back to the lows that were struck in late November, which was looking like a capitulation move at the time, around about 103.30. Haven't updated this RSI earning at the moment. You can see just very quickly it's gone and broken its uptrend, and it looks like MACD is about to go and confirm that signal. It's now looking like it might roll over and cross the signal line. Can I indulge and have a quick chat about the Swissy? Because it was an interesting move. Obviously, the Swiss National Bank overnight, when it cut 50 basis points, most economists were looking for a 25 basis point move. Markets were kind of like evenly split as to exactly what would go and take place. But it's been really respectful of technicals. I like the Swissy. It's almost up there with dollar yen in terms of, for me, trying to go and get signals. I was talking at the time when I wrote a note about it before the release, before the rate decision, that the risk of skewing to the upside, kind of implying that the Swiss National Bank might go and deliver a 50, and you can see that's taking place. So it took out resistance here at 88.95, now it's settling above that level. If we go and get a retest here, nice level to go and look to reset longs, and you could potentially look for a move back up to 89.59, or even above 0.9, as you can see, just a couple of market tops that were struck earlier this year. Let's go and look at some of the markets. Actually, I'll have a quick look at gold. I'll give you some unfortunately, it looks like we might have stalled. There we go. Okay. All right. So yeah, gold. Period of consolidation here. China stimulus announcement came out on Monday. Push jump up. We went through the 50-day moving average. Then again, ran into resistance 2720. That was always going to be an important pivot level. You can see here right now, bearish engulfing candle. But you've still got this level 267650, very minor levels acted as both resistance and support of late, and then the important 50-day moving average just below. To me, if you're dabbling in gold at the moment, that would be a level to go and monitor. Respect how the price interacts with that level. If it can't break through, you could look to go and reverse it again. Alternatively, if it was to break through the 50-day moving average, you could look for a return back towards the lows that we saw in late November, around about just above 2,600. Let's look at some of the other markets, equity indices. Here in Australia, ASX 200. Not looking great, is it? You can see here, uptrend, broken, and then it's been one-way traffic. We saw this big bullish dragonfly doji, which looked like potentially that could go and maybe see a reversal back towards the highs, but no, you can just see it sold into pretty aggressively. And you can see here, approaching the contract roll, it's just been selling at this point in time. In terms of what we're looking at the downside right now, there's not really a lot major to go and speak of until we get back to 80.80. You can see here, which is a level that acted as both resistance and support earlier this year. There is probably a little bit of support potentially in place around about 8174, but right now it's not oversold. Momentum indicators are all rolling over like the price. Yes, we're having a bit of a bounce back today. Let's see how we go at 8310, which is this minor horizontal level that acted as support earlier this year. If that's to go and stall there and not be able to go and break back through this level, after doing away with the uptrend, potentially could look to go and initiate shorts, stop above, moving for a move back towards 80.80. Let's finish off very quickly with some of the markets in the United States. It's I wish there was more to go and talk about here, but yes, there's been a bit of chop around the top, but it's just consolidating near record highs. Not a lot. This is not a line anymore I'm interested in. So you can see here at this point in time, I don't really have any clear directional clues. When you look at what's going on when it comes to RSI 14, it's trending lower, like we're seeing in price. You're also seeing that MACD is also rolled over and crossed over from above ever so marginally. So at this point in time, there's a slightly bearish tilt, but I'm much more inclined to go and just respect the price action right now. I would not be surprised if we saw a move back towards 59870 futures. You can see that area acted as both support and resistance back in November. That would probably be bought, especially when you've got the 50-day moving average right now. But just whilst the momentum picture is waning a little bit, at this time of year, it's historically a seasonally very strong period as well. Respect the price action at this point. Nasdaq had a big rally earlier this week. I can see here, no, not exactly the way you'd like to go and see it when it came to potentially like a market bottom or something like that. You can see here, Morningstar, big bullish candle. Then yesterday, a bit of consolidation back. And you can see here again, up to date. It's trending high with RSI 14. MACD is also pushing higher. So the high-flying Nasdaq relative to the S&P 500, which is getting weighed down by non-tech areas, it's got to be said, is looking a little bit more punchy when it comes to upside potential right now. On the downside, 21,340.75 is an area to go and note near term. With that, we're nearly half an hour. Let me go and see whether there's any questions that have come through over the course of this particular meeting. I don't think I can go and see anything right now. So with that, I'll go and come back and say thanks to everyone who came and attended today's webinar. Thanks to everyone who's attended over the course of this year. If you've got any feedback, any other questions you'd like to go and ask at a later time, you can find me on X at Scutty, and I'm happy to go and try and give you any general advice when it comes to some of those questions that come through. But everyone, thank you so much for attending. I hope you have a Merry Christmas, Happy New Year, safe time spending with your family and